So the participation rate is a multiplier. It's the first multiplier in these. So the participation rate for these two is 160%. That basically reflects how many options can they buy for the amount of money that they have allocated to go buy options. So they can buy 1.6. So they give you 160% participation rate. These ones are set at 175. While PIMCO's at 175 in the 15% multiplier, Bloomberg's at 180. Okay. And in these two, they're both 175. Participation rate just reflects how many options they can buy. So the lower the cost of options, the more they can buy, which means a higher participation rate. So like, as an example, the S&P index, options are very expensive in the S&P index. The way that these IULs work, you choose the allocation, they're going to go buy a call option based on that. So they're not going to go buy the shares of the Bloomberg index or the S&P index. They're going to go buy a call option on it. And if you're not familiar with options, this is going to be very confusing. So when you do a lease option, somebody is buying the option from the seller to buy that property, and they're going to pay for that. That's what an option is with stocks or indexes. They're just paying for the opportunity to buy that index at that price. In this situation, the S&P index is at 4,000 right now, or right around 4,000. Okay. So if you chose to allocate your money to the S&P index, they're going to go to the market, and to cover your position in here so that you can get gains, they're going to say, okay, I've got $500 to go buy options with based on the amount of money you put in, right? I've got $500 to go buy options with. I'm going to go buy an at the money option. So I'm going to buy the ability to purchase the S&P index a year from now for 4,000, which is what it's at today. Okay. Now, if the S&P index goes up between now and next year, that option is going to be worth money, because at expiration, let's say the S&P index goes up 10%. Okay. So it goes up to 4,400. I have, not me, but the insurance company has the option to buy those S&P index shares for $4,000. And because it's selling at 4,400 that day, they could immediately exercise that and then sell those shares for 4,400. They know that there's a 10% gain there, and they pass that on to you. You make 10%, unless there's a cap. Because S&P options are very expensive, they can't take $500 and buy a 1-year option. It costs more than that. That 1-year option, let's say it's $800. Okay. So what they'll do is, instead of having an uncapped option, meaning it can go up as much as possible because they only had to buy that, they're going to enter into what's called a spread. So they buy that 1-year option, and then they sell above 10% to somebody else. If that index goes above 10%, somebody else bought that option from us. They're going to take advantage of the gains above that. But I sold that option to somebody for $300. So this costs $800. I sold that for $300. That gets me my $500 budget. They're able to afford a 10% cap. Now with these indexes, they're less expensive. So they can go in and not that $500, that same 500 doesn't buy just one option. They can actually buy multiple options with that 500. In this case, 1.6. You can buy 1.6 of them. And they buy a ton of this stuff. So it's like, if you try to do it, you can't buy 1.6. You can buy 1 or 2 or 3, right? But because they buy so many, they're able to allocate it in smaller than 1 increments. So that $500 buys 1.6 of the Bloomberg index. That means they can give you 160% participation rate, because the amount of money that you had out to allocate was able to buy 1.6 of those options. So if it goes up 10%, they own 1.6 options on your position. Okay. That's what determines the participation rate. For these index options, they can give you 1.75 for this one, and 1.75 for these two. This one is currently 1.8. Okay. But that can change year to year. It's the only thing in this that can adjust. And that makes sense because the options change. The cost of options change. They have to be able to adjust how much your money is actually buying that year.
Hope you found value in today's video. If you'd like to find out more about IUL and whole life, check out these videos right over here, and we'll see you next time.
Now go maximize your cash flow.